Think about a company you love, a brand you use every single day. What if you could profit every time someone else bought their product? Not as an employee, but as an owner. For most of us, the stock market feels like a giant, intimidating casino. A chaotic world of flashing green and red numbers, frantic traders shouting on a screen, and charts that look like heart monitors. It seems like a private club for experts on Wall Street, not for regular people. We hear stories of fortunes made overnight, but we also hear the terrifying stories of market crashes that wipe out life savings. It feels complex. It feels risky. It feels like gambling. And this feeling stops millions of us from ever taking part in the single greatest wealth creation engine in history. Consider the story of two friends, Liam and Sophia. Every morning, they go to the same popular coffee shop. They both love the coffee. Liam buys his cup, drinks it, and that's it. The transaction is over. Sophia also buys a cup of coffee. But a few months ago, she did something else. She took $200 and bought a few shares of the coffee company's stock. Liam thinks she's gambling. What if the stock goes down? He asks. Sophia sees it differently. She sees a business she understands. Every time she sees a long line at the counter, she feels a little sense of pride. She knows that every single cup of coffee sold, to her or to anyone else, adds a tiny fraction of a cent to the value of her ownership. Over the years, Liam will spend thousands of dollars as a customer. Sophia will also be a customer, but she will also be an owner, benefiting from the company's success. This is the difference between simply spending money and owning the businesses you spend money with. This brings us to the most important revelation about the stock market. A stock is not a lottery ticket. It's not a bet. The word stock is just financial jargon for a simple idea, a share of ownership. When you buy one share of a company, you are not betting on a number. You are buying a tiny, fractional piece of the actual business. You own a sliver of their factories, their patents, their brand, and, most importantly, their future profits. This is the fundamental mindset shift. You move from being a gambler at the casino to being a business partner at the table. So, how does this work in practice? Let's use an analogy we can all understand. Imagine a successful local pizza shop. The owner decides she wants to expand, but needs money to open new locations. She decides to divide the ownership of her entire business into 1,000 equal slices, and sell them. Each slice is a share of stock. If you buy one slice, you now own 0.1% of the pizza business. You don't get to decide the toppings, but if the business does well and its profits grow, your slice becomes more valuable. If they become a national chain, your tiny investment could be worth a fortune. These slices, these stocks, are traded on a giant marketplace, like the New York Stock Exchange or the Nasdaq. It's just a place for buyers and sellers of these business slices to meet. Now, not all pizza shops are the same, and neither are all stocks. They generally fall into two categories. First, you have growth stocks. Think of a new, innovative tech company. It's pouring all of its money back into the business to create new products and grow as fast as possible. This is like a pizza shop that uses every dollar of profit to open more stores. It doesn't give you any cash now, but the potential for your slice to become dramatically more valuable is high. Then, you have value stocks. Think of a huge, established company that sells toothpaste or provides electricity. It's not growing at a breakneck pace, but it's very stable and consistently profitable. These companies often reward their owners directly. They take a portion of their profits and pay it out to their shareholders as cash. This payment is called a dividend. This is like a pizza shop owner who, at the end of every year, sends you a check for your share of the profits. So how do investors even begin to tell if a stock is a good price? They use simple metrics. One of the most common is the price-to-earnings ratio, or PE ratio. Don't let the name scare you. It's just a price tag. It tells you how much you have to pay for $1 of the company's annual profit. A company with a high PE ratio means investors are willing to pay a lot today because they expect big profit growth in the future. A low PE ratio might mean it's a stable, slower growth company, or maybe that it's a bargain. It's a quick way to gauge the market's expectations for a company. Now, this might sound like you need to become an expert analyst to succeed. You don't. As we learned in episode 3, trying to pick the one winning stock is incredibly risky. The smart strategy is diversification. And as we discovered in episode 5, tools like low-cost ETFs allow you to buy one single thing and instantly own a small slice of hundreds, or even thousands, of the world's best companies. You can own the growth stocks and the value stocks, all at once. But understanding what a stock truly is, that is the key that unlocks your confidence. It changes investing from a scary gamble into a logical act of ownership. The goal is not to be a day trader, guessing which way the market will move tomorrow. The goal is to be a long-term business owner, patiently participating in the growth of the economy. The stock market is the engine that has powered compound interest for generations. It has turned small, consistent investments into life-changing wealth. It is not a private club. It is an opportunity. And you now understand the price of admission. It's not about having a lot of money. It's about having the right knowledge. Becoming an owner, not just a consumer, is a powerful shift in perspective. But that power multiplies when we share the owner's manual and build our understanding as a community. Our mission is to tackle the financial questions you're actually asking. Let us know in the comments what practical challenges you're facing, and your idea could shape a future episode. Subscribe and join the conversation.